Hi, in this section we're going to talk about the calculating net working capital in the IRR page. There are a couple areas where the net working capital needs to be calculated. At the core of this analysis is really the understanding of how the net working capital requirement correlates with the revenue of the company. So typically what we would do, we would develop one very important assumption here that has to do with which is what percent of revenue does the company require to keep as its debt-free, cash-free net working capital. There are two parts of this calculation. One part of the calculation is relatively straightforward, where we looking at the ongoing change in the net working capital. The ongoing change in the net working capital will depend on the changes in revenues here. In other words, for this particular client, if we want to calculate the amount of investment that the company needs to make in 2012 for into the net working capital, then that investment into the net working capital would be calculated as the difference between the revenues in those 2 years multiplied by that requirement, 1.2% in this case. So this is where 37 comes from. It's 20 minus 17 times 1.2%. That's the amount of investment one needs to make. Investment, in other words, the company makes the profit, but they can't really take all the profit in the form of their cash flows. They need to freeze or leave certain amount on their balance sheet so that they can continue being solvent and run their operations and pay their bills and such. So those calculations are pretty straightforward, especially in these cells, because it's again purely the difference between revenues times the requirement, that requirement percentage. The things are a little tricky at the beginning of this analysis. So first of all, this negative 4%, that's the again this ongoing investment in the net working capital that should be again based on the changes in the revenue. The way this negative 4% is calculated, and it could be negative, it could be positive depending on the industry. For example, software industry may have very positive effect on the cash flows through the investment in the net working capital. It's actually the situation where the customers pay before they receive service, and so the company can actually finance itself through those upfront payments. In other words, the net working capital will contribute positively to the debt-free cash flows. So again, going back to this negative 4, the way it's calculated, we go back in the model, and you'll see that the valuation date for this analysis is 11/18/2010. And so 12 months leading to 11/18/2012, company had 14,293 in revenues. By the end of this fiscal year, the revenues will be 14,664. In other words, in this relatively short period of time of about 6 weeks, the annual run rate of revenue for this company will grow from 14.2 to 14.6. So what we do in this case, we take the difference between these two numbers, multiply it by 1.2%. Again, it's our required level of net working capital, and that's how we arrive at 4. Now you'll notice here this factor, which we call a partial relative to last full year reported. That's a convoluted name for what it is it is actually pretty rare that you find this such good number as 14,293. Many times companies don't track their revenues like that, and so you might either have to calculate this number based on some historical information and slicing and dicing the historical revenue numbers, or this number could be as of, for example, 6/30/2010. If it's 6/30/2010, then what we know is that this 4 let's say this number is something different. Let's say it's 13,000. So now we know that this 20 increase in net working capital did take place, but it took place over a course of half a year. But for the purposes of our modeling, we're only dealing with a stub period, which is only 6 weeks. And so this factor 1 would actually need to be recalculated so that this 20 number can be adjusted to reflect the fact that the delta in those revenues is too big for us. And so in other words, what we can do here is we can find that factor again based on the length of the period between these two numbers and the length of the stub period. So let's revert that. And so this is where our 4 comes from. So that is to account for this small amount of net working capital investment that we have to make in the stub period. The second part of it is the upfront investment. So upfront investment is, as I mentioned in the earlier session, has to do with the fact that the company, when the target is acquired, the balance sheet may have too much net working capital or too little net working capital. And so if the balance sheet has too much net working capital, too much relative to the operations that the company is running, then the acquirer can actually cash in and reduce the net working capital and reduce the cost of the acquisition. If the company has target has too little net working capital, then we have to make additional investment in the balance sheet of that company, and so the acquisition becomes more expensive. So in this case, you'll see that this revenue number 14,293, it's the same as this number. So that's trailing 12 months leading to the acquisition date. The required level of net working capital is calculated by multiplying this 14.293 by this 1.2, and that's this number 174. So that's what's theoretically required to run those operations. When we acquired this company, what we found as we looked at the closing balance sheet is that they actually had negative net working capital of negative 582. And so in other words, there is a deficit in the net working capital, and the acquirer would have to make an investment of $755,000 into their net working capital to normalize and run the operations of the target appropriately. So this 755,000 is really the difference between theoretical required and actual level of net working capital. Because this investment, we assume that it happens on day 1 to run those operations. It doesn't have to be discounted, and so this number 755, you'll note it goes here. And again, it's with minus because it reduces the value of all those other cash flows and positive things that we acquired. That's how it affects those operations. And that's how it affects this calculation.